Risk parity, it's a hedge fund strategy. They've attempted to democratize it by putting in this ETF, holds other ETFs in a variety of asset classes like equities, commodities, tips, treasuries. The goal is that you're basically using risk to determine the weighting. So let's look at the holdings here of this, which, by the way, is 170 million, pretty big for a new fund. That's why we're kind of looking at it this week. And you can see it's a real, pile-on of different securities here, ETFs, individual securities. But again, it's all different asset classes. Now let's look at how it performs versus the other risk parity ETF that's in Canada from Horizons and the S&P. So if you go into something like this is the fund we're looking at today. This is the S&P, but this is 1/4 the volatility of the S&P. And here's the one from Canada, which leans Canadian. That's why it's trailing. So Taylor, this is kind of like a hedge fund strategy for 50 bips, and I think that's the value add here. Question is if you look at the S&P, it could be a little hard to watch.
Well, with us now to discuss this ETF, it is Alex Shahidi. He's a partner at Advanced Research Investment Solutions. He joins us now from Los Angeles. Alex, walk me through how a risk parity ETF fits into a broader portfolio that may have other risk characteristics in it.
Sure. Most investors are slotting it into the alternatives category, similar to other multi-asset strategies.
Yeah, when I talk about this fund with people, they'll go, well, this is fine, but you really need to leverage up here. I think you guys are 20% leverage. They'll say you need to go way beyond that to feel the oomph of a risk parity strategy, and you're not getting it in the ETF. What do you say to that?
Well, there's really two levers, and this particularly applies to the fixed income portion, the treasuries and the tips. There are two levers to increase risk. One is leverage, as you mentioned. The other is to have longer duration. So the bonds that we own are longer duration treasuries and tips. So between the two, you can get an equity-like risk without using a lot of leverage.
Do retail investors understand the idea of risk parity, or is this an institutional investor knowledge base?
Well, many of the investors in this ETF are retail, high net worth individuals. And I think the concept of risk parity is going to become more popular over time. So I think they do understand it, and I think they'll understand it better as perhaps the next bear market arrives.
Speaking of which, we've seen this situation where everything goes up or everything goes down. Will that affect this new era? Will that affect the returns of a strategy like this? Is the data used to that kind of a scenario?
Well, I think that happens occasionally, but those environments tend to be short-lived. If you look at over longer periods of time, these assets tend to go up and down in different environments, and particularly during major market dislocations when you need diversification the most. For example, in Q4 2018, 2011, and then particularly in 2008, the safe haven assets, treasuries and gold, actually did quite well in those environments when many other assets sold off.
Alex, what do you do when the Fed comes in, as they have in the last decade, and everything is correlated on a 0.5 to +1 basis, and you don't get assets that are no longer uncorrelated?
Well, I think you do get that real diversification benefit during those major dislocations that I just mentioned. So Q4 2018 is the most recent example of that. Treasuries actually rallied. Gold did really well in that environment, and that was a period when the Fed was working with the market in terms of moving interest rates.